over the past few weeks, I think since the election, what we've seen is that there are higher expectation of inflation over the next few years, which has moved the 10-year interest rates higher. And that's kind of what we're seeing. They went from about 3.6 to about 4.4. And because of that, what we've seen is the mortgage rates go up from about 6% a few weeks ago to about 6.8%. And again, that is all tied into what the market expects from an inflation perspective, which obviously is the baseline. I want to at least make sure that I get my inflation, and that's kind of what investors are expecting. So that's a bit of an overview of interest rates. I really don't want to go super deep, but I wanted to give all of you a sense that interest rates are going up or down. It's a blessing or a curse, depending on who you are. And it's not always good news or bad news. Now, I do want to point out one more thing, is that the inflation has been expected to go up in part because of the election. And I don't want to get political, but I do want to spend some time on this idea of politics in elections, because it is very, very fresh in everybody's mind. And I have to say, I have noticed how anxious people are, and they have been for a while around this election. And in a way, it's legitimate because it is touching on our deeply held beliefs, our core identity as individuals. So I think it's legitimate to say that this has had an impact on all of us, because it does touch on our deeply held beliefs, our core identity as individuals. And because of that, it triggers these very strong emotions. I also believe that these emotions are perfectly fine to have, because that's what makes us human. So there's nothing wrong with these emotions. What I also found is that really successful investors can acknowledge these emotions because they're real. It's what makes us human. And at the same time, take a step back and disentangle them from investment decisions, and be a lot more pragmatic about those investment decisions, and make them based on data and evidence rather than how we feel, because those are two different things. So I can tell you that a lot of folks are anxious today. Others are ecstatic. And should he make decisions based on those feelings? And my suggestion is, let's take a step back and see exactly what is going on. What's the economics of the market, and what does the data suggest? So to begin with, let's just take one step back, as I said, and think of the market not as this gambling casino where you make money, you lose money. That's not what the stock market is. I think the stock market, in its defense, I'm a big defender of the stock market, is a fundamental premise of our society. Because what the stock market allows all of us to do is go buy ownership in companies that we did not start. I have nothing to do with Microsoft. Talking about Microsoft, I don't know Bill Gates. And yet, if I go to the market, I can buy a share of Microsoft, which allows me to have a piece of the profits and the earnings that that company makes. Pretty much like Bill Gates. Not as much as Bill Gates, but certainly conceptually, I can partake in the success of that company. And that gives us all a stake in capitalism, which is fantastic. And we can participate in the ownership right now of about 12,000 companies around the world. So when an election happens, the stock market basically is trying to assess what is the value of owning a piece of a business. That's what the price per share means. If I buy this business, how much should I pay for it today? And every single second, the market's trying to assess the impact of various events onto profits and earnings that companies are expected to make for years and years to go. That's what the market's doing. It's assessing the value of a business today based on what is going on in the world, and forming an expectation on the impact. And if it's a positive impact, it's going to go up in value. And if it's a negative impact, it's going to go down in value. And in that respect, when the election happened, not just the actual election day, but even before the election day, the company, the stock market had an assessment of who do they expect to win. And based on the policies that are being discussed during that particular campaign, what the impact might be on different companies. So a lot of what is likely to come has already been priced in, meaning that the market has already adjusted the price based on the expectation of a policy that might help or perhaps hurt a particular company or sector. So you got to be careful not to get on the bandwagon too late, and that's what typically happens: is the investors get on the bandwagon too late, and by the time they get there, the price is already adjusted. The second thing so the first thing is that the markets are forward looking. They adjust the price well in advance of a policy being implemented in expectation of that policy. The second thing to note is that whatever the policy is, companies are not going to, just lie down and just take it. They're going to try to figure out a way to make it work. That's the resilience of any business. You try to figure out, how do I make it work? And if an obstacle or barrier is putting in front of me, well, I'm going to try to see, how do I go around it? And that's the second important thing. And the third one is that each company's success is based not only on the government policies, but a lot of other variables that are under their own control, which is the products, the customer service, the strategy, how they execute, what competitors do. And because of that, you can find some very random results. So let's look at these three ideas that I put forth. The first one is that the markets price things in. The second one is that the companies are looking to adjust whatever the policy might be. And number three is that the results might vary even within the same industry. So I'm going to start with the first concept, because I think that it's quite interesting to look at the policies that were being talked about during the campaign. And the upcoming administration has really talked a lot about tariffs. Tariffs. We're going to tariff everything. And we're going to, charge tariffs. And tariffs are certainly a tool that the government can use. And as an economist, you kind of look and say, well, who's paying the tariff? And it is the importing company. There's just legal logistics. And quite often, when you look at the data, what you see is that the prices tend to go up because the consumers are the ones that typically pay more. The companies tend to pass those extra costs to the consumers. So one of the reasons that we saw this increase in inflation expectation is perhaps because of tariffs. Now, if you're a company and you look at how they impact you, it's good to go back and see how unpredictable the consequences of tariffs can be. And to do that, I'm going to tell you maybe a story that I like, just because it just sounds fun. It's called the chicken tax. And I'm not sure how many of you are familiar with the chicken tax, but the chicken tax is a good story. Back in the 1960s, the U.S. farmers were exceedingly good at producing chicken. And they start shipping a lot of chicken at a very low price around the world, including to Europe. And the good old European farmers are like, whoa, wait a second, what's with all this American chicken? And the German farmers in particular, they're really incensed. They said, well, this American chicken is killing us. So they went to their legislators and said, do something about it. And the German legislator basically said, okay, we'll put a tariff on the American chicken so we can protect the German farmers. And that's what they did. They put a chicken tax on the American poultry. Now, the Americans got all incensed. It's like, wait a second, we just gave you all the money for the Marshall Plan, and now you're going to tax our chicken? That's not right. You can't do that. And they said, okay, well, I know you're selling a lot of VW bugs and buses back in the 60s. And the U.S. government got a hold of the fact that the Germans were about to release, VW in particular, was about to release a pickup truck. And what they said, okay, you taxed our chicken. Well, what we're going to do is we're going to put a 25% chicken tax on pickup trucks that are made abroad. And at the time, there are no pickup trucks made abroad except this upcoming VW pickup truck. How many of us have heard of VW pickup trucks? Not really. Nobody's ever heard of those because they never came along. It just basically killed the whole thing. But in the process, a few things are important to know. The first one is that it gave the U.S. automakers a huge leg up in that particular segment. And that's when you think of a pickup truck, it's the F-150, it's the Dodge Ram, the Silverado, because the U.S. automakers have been really protected in that space by the chicken tax, which, by the way, is with us today. It's still in place today. 7 years later, 60 years later. So that's the first thing. The second one is that consumers now have fewer choices, probably not as much innovation in pickup trucks. But the third one is it offers a lesson of how did companies negotiate with that. If you're one of these companies that couldn't import without paying the duty, what do you do? It seems like pretty straightforward. Well, not really, because there are examples of how companies try to get around the chicken tax. And one of them comes from Subaru. Back in the 60s, they had a vehicle called the Brad, the Subaru Brad. And what they did to kind of get around that, they bolted two seats in the bed of the truck, and they said, well, it's not like a pickup truck. Look, he's got two seats in the back. And obviously, as a consumer, you can just unbolt those and you get your pickup truck. So that was one way that companies did it. The other one is Ford, for example, when he was bringing in pickup trucks from abroad, what it did, it basically just said, okay, don't put the bed. Just make it out there and just don't put the bed, and we'll attach the bed when it gets here. So is this a pickup truck? No, it doesn't have a bed. So don't categorize the pickup truck. It's just it's got a cabin. And so the companies try to get creative and figure out. And I think that's an important lesson that companies will look to negotiate with whatever is put ahead of them. So that's kind of the first lesson, that companies do get creative. They're resilient. They'll figure out a way to do it. And the outcome over the long run is unpredictable. And in some ways, it could actually benefit U.S. companies, but it will hurt consumers. Now, what about this other idea that getting the government with some of these is going to benefit a company? And to look at that, the previous administration in 2017, when they came in, they said, we want to make more things in the U.S. So they talked about domestic manufacturing and how to support it, how to bring it to life. And one of the industries that they picked on was steel. And it turns out there's a company that carries the name of the industry. It's called United States Steel Corporation. And if you look at the price per share for United States Steel, it was dropping quite a bit. It lost, more than half the value in a fairly short time. And then the administration started talking about tariffs. Well, let's just put tariffs in place. And when they start talking about that, perhaps in expectation of those tariffs, again, there are no tariffs, but in expectation, which is what we talked about it, what you saw is that the stock price just starts significantly going up and going up and up and up and up, almost double again in value. And in that respect, you got to go, wait a second. So that's a good thing. So if the government gets behind us, well, that might be a good reason to get behind U.S. Steel, because there are policies that support the steel industry right now. But there was no clarity. There was nothing. There was just an expectation that maybe tariffs will come. Did they ever come? Yes. March of 2018, you got steel tariffs against foreign producers that gave U.S. Steel a very big leg up. And that's when investors, I heard a lot of folks saying, this is where we want to invest now, because the government has the back of U.S. Steel. So what if you fell into that seductive narrative and you bought U.S. Steel? Well, by the end of the previous administration, U.S. Steel had lost most of its value, despite the fact that it had the full the full backing of the U.S. government through very tangible and serious tariffs. It did not make a difference. It lost the majority of its value, and partly because it's about maybe when the price of steel goes up, which is what happened. Car manufacturers and washing machine makers, they didn't buy as much steel. You're going to have foreign countries reciprocate and make it harder for U.S. Steel to compete. Perhaps their customer service or their products. There's so many variables, but ultimately, just because the U.S. government has your back does not mean that much. And even if you look at the steel industry, look at the current administration. There's a good example, because the current administration has been pushing much more green energy and sustainable energy, which a lot of folks believe. And frankly, 3 years ago, I wanted to put some solar panels on my roof here in LA, and I got a bid from a company called First Solar. And recently, I looked to see what would have happened if you had invested in First Solar, over the past 3.5 years, and you would have more than doubled your money. So really nice outcome if you invested in First Solar and solar panels companies like First Solar. Now, because I remember being a somehow halfway smart consumer, I also want to get another bid just to make sure I'm not being overcharged. And if you go to Costco right now, in fact, there's a booth that is not by First Solar, but by Sunrun. So if you look at Sunrun, it's an alternative company that does the same thing. Sunrun, over the past 3.5 years, despite being exactly in the same position as First Solar, it lost about 75% of its value. And when they started, their price per share was pretty much neck and neck. And then it just completely diverged 3.5 years later. And why is that? It might have to do with the customer service, the strategy, so many other variables. But just because the government has your back doesn't mean that that's going to translate in investment success across the board, which is kind of the third idea that I put forth. And by the way, I was in Oklahoma not long ago, and somebody said, "Yeah, but at least they had some friends in DC. Fossil fuel has been terrible. Nobody likes fossil fuel. Blah blah." And just out of curiosity, I looked at ExxonMobil over the exact same time period. You would have more than tripled your money. More than tripled your money in that time frame in an industry that doesn't appear to have as many friends in DC. So don't get caught up in that seductive narrative that, hey, somehow this is going to translate in success or not success. It's just not the case. There are too many other variables that might make a difference. So what if you go now from sectors to broader policy? Because presidents come in and they do have a lot of initiatives. They'll have a lot of ideas. And to what degree do those impact the market? And what are the policies that really help the market versus hurt it? And we have data in the stock market going back to the 1920s in the US. And rather than go in the 20s, what I thought I would do is go in my lifetime. I'm born in 1969. I'm 55, and I wanted to know. Okay, the market on average has grown by about 10% per year. So I'm going to use that as a yardstick. 10% per year is the growth in the U.S. market. Now, what if you look at the average per year annualized for different presidents? How does that compare to 10%? What can we learn from looking at the different presidents and their performance while they were in the White House relative to the market? So when I was born, President Nixon was in the White House, and for about 5.5 years, the market, in fact, did not grow, but dropped by about 2.9% per year on average. And then he leaves the White House, and his vice president comes along, Jerry Ford, and the market skyrockets at over 20% per year. And by the way, Gerald Ford was never elected vice president. He was never elected president. He was a president. They just incidental. They just happened to be around there, and he eventually got in the White House. And in 1977, he loses to Jimmy Carter, who comes in for one term. The market on average goes up by 11.7%, a bit above average. And then in the 1980s, President Reagan comes along, 2 terms. The market goes up 15.8 for 8 years on average. And then his vice president comes in, 1 term, 4 years, market goes up 13.9%. Followed by President Clinton in the 90s. The market goes up quite nicely, 17.6 for 8 years in the 90s. And then we had that contested election, Bush versus Gore. And if you remember, President Bush comes along, and if you look at the 8 years of the George W. Bush administration, interestingly, the market on average drops by 4.4% per year for 8 years. And then we had President Obama and then President Trump. And the reason I put this up is that I want to start with just the basic question. Is it obvious that having a Republican or a Democrat in the White House is better or worse for the markets? And the reality, folks, you can't say that. I mean, I've asked this question to audiences around the country and the world, and nobody can say there's an obvious pattern. Now, what about policies? Certainly it was the case that there was a president who cut taxes to specifically the stock market investing, capital gains dividends. And if you heard about that, it would be like, well, that's really good news for the market. I do expect the market's going to jump because we have these tax cuts. And we did have exactly that set of policies, and they came from none other than George W. Bush. And yet somehow, despite these incredibly tax-friendly policies, the market dropped by 4.4%. Was he a terrible president for the markets? I don't think it's fair And I don't think it's fair at all to say that he was not good for the markets. Why? He came in just as the dot-com was going bust. How much did he have to do with the dot-com bust? Nothing at all. 9/11 happened 9 months into his term, and he walked off at the very bottom of the financial crisis. Should we say that he wasn't good for the markets? I don't think that's fair. The same way that if you look at President Clinton, well, he happened to be there in the early 90s just as Microsoft and Pets.com and Amazon, they're all taken off. And again, I'm not sure how much the White House had to do with Microsoft Windows or Office or any other things that happen in Silicon Valley. So it is, you got to be careful assigning credit or blame. But what about policies? Because I hear so much about President Reagan. He was very good for business. And he really made a big difference because he was focused on tax cuts and initiatives to stimulate growth. And the market responded really well, 15.8% per year on average. And I do remember that when President Obama was running, there was anxiety in some parts of the country, because what if we elect somebody whose priorities might be around social programs rather than business and tax cuts? Well, it's going to be a bloodbath in the market, and we need to, sell everything and move to Canada because that's not a socialist country. So they're afraid, and people are afraid, and they say it's going to be terrible in the market. So how badly did the market do during a president really known for healthcare rather than business initiatives and tax cuts? On average, it went up by 16%. What's the difference there? It's not really any difference. Whether you have a president focused on taxes and business versus one focused on social programs and healthcare. So it is interesting that quite often people want to believe a certain thing. And I think it's their emotions being projected onto what they think is going to happen in the market. But when you look at the data, there's nothing to suggest that this is going to be the case. Now, it's not all about presidents. And as we know right now, we have a unified government. The Republicans are in control. And interestingly enough, 2 years ago, this is exactly 2 years ago, it was exactly the opposite situation. The Democrats were in control. And 3 years ago, I had this thought that perhaps, if you have a split government, it's hard to say how the policies of any one party drives the market. On the other hand, there are times perhaps when one party is in full control. In other words, they control the White House, they control the Senate and the House at the same time. So if we look at times when one party is in full control, well, that might give us a sense of which party, which set of policies might be better or worse for the market, because again, it's more than just the president. So when I went back to the 20s, this is like 3 years ago, when I went back to the 20s, what I found interesting enough is that the Republicans had this single party unified government control for 13 years. And a simple average of these 13 years showed that the market did well. It went up by 14.52%. And that's during the Republican unified single party control. What about Democrats? Well, it turns out they also had this single party control, but not for 13 years. It was actually a lot longer, 34 years, where they had this unified party control. And the question is, well, how did the market do during the 34 years of the Democratic unified government control? And folks, I remember 3 years ago, somebody stood up and said, listen, I don't want to see this number because you're going to try to sell me on one party being better than the other. I don't want to know. And I was like, no, I'm just going to show the number. I know you're very emotional, but you make your own conclusions. You draw your own conclusions from this. And when we average the 34 years when the Democrats were in control, it turns out that on average, the market went up by 14.52%. It is identical to the second decimal, So when people are saying that, look, one party's better than the other in the market, when one president, one set of policies, all of this, there's nothing in the data that suggests that you ought to make a move with your money solely because of politics. And it makes sense. Again, it's a company who's looking to make money. You look at Apple or Facebook or you name it, or Nvidia, what's going to matter more? Who's in the White House or their products, the services, strategy, how they execute? Politics is one of the many variables that impact the success and the profits of the company. It just turns out it's not a primary one. It's not one that you can point and say, here's the election outcome. and that's what's going to happen to any one company or the market. And maybe, Jonathan, I'll wrap up with just a little thought that I had because I was baking cookies with my daughter. And when you bake the cookies, you put in the eggs, the sugar, the flour, the butter, you mix everything in, you pop it in the oven. And when the cookie's done and you break it apart, you can't really point and say, aha, I recognize the egg yolk in there. No, you can't. It's mixed in with so many other ingredients that it becomes indistinguishable. And that's what I think politics is ultimately. It's the egg yolk in a cookie. It's somewhere in there baked. It's just not something that you can see, and certainly not something that you want to build an investment strategy around it. So don't make an egg yolk cookie. That's not going to be very good. But rather acknowledge it's somewhere there. The markets have already priced it in, and the companies will be resilient enough to navigate whatever times. And folks, let's not forget, 2 years from now, there will be another election. 4 years from now, we're going to go through exactly the same process as we did today. And a lot of the companies, when they have these long-term horizon, they're not making decisions based on what's going to happen over the next 2 years. Their projects might take 4 or 5 years even to get started. So a lot of the decisions are, they're not based on politics. And because of that, I really want to kind of emphasize again how strong these emotions are, how legitimate they are. And at the same time, you are buying ownership in companies around the world. You have 3,000 companies in the US, about 9,000 others around the world. They're all going to try to find a way to make money irrespective of who's in the White House. And us as consumers are going to continue to be resilient. I had the same exact bowl of yogurt with berries the day before and the day after. I mean, we're all consuming the same thing. We're taking our trips. We're doing the same thing. And that's what the resilience of consumers that leads to resilience of companies and ultimately the resilience of the market.
Okay. Hi, everybody. Good morning. First of all, Apollo, thank you for a masterful presentation. I think you're too humble to let people know that you are one of the giants on whose shoulders we sit. Dimensional is pretty much informed by the wisdom of Nobel Prize winning economics. That's not stock picking or market timing, as you see. And we say at RVW, we say we don't predict, we prepare. And that's really the approach we use. We think of our portfolio of equities as being a kind of a Darwinian best of breed selection process, picked based on the attributes or factors that are present in the companies. As Jonathan has said, we neither look to the future because nobody predicts accurately, nor do we look to the past because it's usually irrelevant in terms of where we are. We are present focused, and our portfolios are internally dynamic in the present. I just wanted to wrap up. First of all, thank you very much, Apollo, and thank you, John, for the introduction. Just a quickie. It's approaching year-end tax time, and I wanted to deal with some evergreen tax principles that I think are worth thinking about. This is the time of the year where if you haven't already done that, you should do a tax projection. In other words, meet with your tax preparer and have them do a quick and dirty of what your taxes are going to look like for 2024. The reason for that is because determining where you are in 24 and possibly where you're likely to be in 25 will determine many of the critical decisions you'll make. For example, do you want to do a Roth conversion to an IRA to a Roth from a regular pension plan? That's very attractive if you happen to have a lean year for income purposes. On the other hand, if you have a high income year for tax purposes, you want to defer some of your deductions. You want to accelerate some of your deductions from next year into this year. If you have a very high taxable income this year, you may want to bunch up your charitable deductions, for example, or your deductible business expenses if you're a cash basis taxpayer. What I'm saying is that the core to tax planning at this time of the year is to do a projection. We have a saying which says surprises are for birthdays, not for tax time. And the last thing you want in April is to find out either that you missed an opportunity, because after December 31st, opportunities pretty much evaporate as to what you can do to reduce your taxes or defer your taxes. You don't want to find you missed an opportunity or you're saddled with an unexpected tax bill. So I would just say to you, at the heart of everything you're doing right now, tax projection is part of it. Instead of fixating on who won the election, and as we heard so well from Apollo, what it's likely to impact the market, we are perma-bulls. We are permanently bullish about the market. And 200 years of history shows you that the market is one long, upward sloping bull market interrupted by periods of decline. I will just give you one statistic that I think will make the point quite eloquently. I came to this country in 1977. The Dow Jones, which, as you know, is not the best place to invest or the best index to rely on, but the Dow Jones, when we came, it was around 850. It's now over 44,000. And all you had to do over that period was nothing. Anything you did that interrupted that tax advantage compounding disturbed the portfolio. And the chance of getting it right, when you time the market, you got to get out at the right time, you got to get back in at the right time. Almost nobody gets those right. Staying in and enduring the price you pay for extraordinary returns, which is simply the enduring of volatility. It's a bumpy ride upwards. That's what it is. And so I wish you a wonderful holiday season, a successful 2025. Let's wish Trump and the Republicans who have taken control much success. We all pray for a successful term, regardless of what you would have liked to happen. We're all now in the same country with the same president, the same administration. We should all pray for and hope for a successful term for everybody and a great year for all of us. Happy holidays to all. And thank you, Apollo. Thank you, John. And if there are any questions or issues, please email any of us. We'd be happy to respond. Thank you.